Hello and welcome. My name is Joe O'Mara. I'm the head of aviation finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Greg Conlon. Greg is the CEO of High Ridge Aviation. He's joining us for the purposes of our Aviation Leaders Report 2024. And I should say we're recording this at the very end of November. Greg, thanks for joining us today and give us your time and insights. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about High Ridge Aviation?
Sure. Thanks, Joe. Pleasure to join you here. I know it's a busy time of year for everybody, so a lot going on. Happy to talk to you guys today. A little bit about High Ridge. High Ridge is, as many folks know, it's really the former, I'd say largely GCAS leadership team. Chose to form an asset management company late last year. We launched in October with about 11 founding partners. We're now at 29 people, about 8 locations. We launched with PIMCO, who is our primary sponsor and LP capital raiser. And we also do, it's similar to what GCAS used to do, Joe. We do obviously structured products. We do primarily operating leases, finance leases, but we also have a debt business, which is LR Air Finance, similar to the PK business we did for many, many years. As I said, we launched about a year ago. Been a busy year so far. Looking forward to catching up with you guys today. Lots going on in the market, and we're excited to be here.
Excellent, Greg. And maybe we'll start on the airline customer focus side. Can you talk to us in your perspectives on airline customer performance over 2023?
I think the airlines generally are still doing pretty well, Joe. I mean, we saw coming out of COVID, there was that really pent up demand for travel. And that was just great news for the airlines because trying to get through COVID for everybody was very challenging from a financial expression, and particularly so in the airlines. They just had to bring in just tremendous amounts of debt just to survive. And as you're coming out of that, there's a lot of pressure on the balance sheets. There's the ability to really the desire to generate cash and start. And we saw a lot of that coming out of COVID, particularly on I say leisure travel. There was just pent up demand, particularly domestically. And that came roaring back quickly. That was probably about most of this year. And now we start to see, a little bit of that kind of pent up travel normalize to more, I'd say, historical levels. And then on the international side, I think that's starting to pick up now. And you're seeing some of those in the U.S. where the international carriers, a lot of them had prints last week, are showing a lot of growth, a lot of traffic. Some of the domestic carriers or LCCs. A little bit more pent up. I'd say it's a little bit slower results in either earnings or cash flow. There's some fare pressures that are coming down a bit, a little bit of capacity pressures, but overall, I think the market in the U.S. is doing well. In South America, they're looking forward to a really good summer season. I think the forward bookings are looking good for them, and I think they're going to do quite well. Europe, again, the same thing. I think there was some concerns about whether they're going to have a soft landing, a hard landing. I think most people are now a little bit on the soft camp and a little bit more optimistic. I think the cash generations from most of the airlines in Europe are doing quite well or better than expected. I think they're very cautiously optimistic about 2024. And then in Asia, I really think it's a combination of, I'd say the bigger, perhaps stronger credits versus maybe the weaker credits or smaller airlines that are more exposed to GTF issues. So there's really a bit of a have and have nots over in Asia. And then I'd say lastly, in the Middle East, some tempered growth and return to, say, pre-COVID levels and tempered off by a little bit about higher fuel rates and higher costs. So overall, I think the airline industry is improving, maybe steadying out a little bit, but those dynamics continue to be positive.
Yeah, and as you say, broadly a positive story there, Greg. As we look out maybe into next year, as you're parsing kind of the macroeconomic environment or geopolitical risk, how's that factoring into your thinking about where you're making bets in terms of geographic opportunities, or are you more focused kind of on an airline by airline basis?
Well, it's a little bit of both. I mean, we've got, compared to where we have a couple of years ago, you've got kind of two major domestic or international, I'd say, dislocation incidents. We have the continuing conflict in Ukraine, obviously the conflict in Israel and Gaza. And whenever you have those international incidents, it certainly drives uncertainty to the world. That tempers economic growth globally, aviation included. I think we're seeing perhaps a little bit more of a wait and see approach on both of these conflicts. And it's so far, Joe, I think it's been a little bit okay in terms of the world response. Certainly, it's a little bit more volatile than we thought a couple of years ago, and we watch that. In terms of macroeconomic impact to the rest of the world, we're watching things like interest rates, global growth rate, China, the world's decoupling situation there, and what does that do to sort of traffic dynamics? But in terms of how we approach the market, we're long-term views. These are long-term assets. They have long-term leases and cash flows associated with them. So we're really kind of taking a long-term view of where we want to build a portfolio, and definitely want to be a global footprint. That's why we have offices all over the world. We've got 8 locations now, and it's really a global business, and you've got to be a global player.
If we kind of talk then to, macroeconomic, geopolitical, uncertain, but when is it not, right? Better face that COVID. Demand very strong. The key challenge maybe in the market right now is supply, both from an OEM delay perspective and an engine challenge perspective. As a lessor that's seeking to grow, or an asset manager that's seeking to grow materially, how challenging is that supply side environment?
Well, the supply challenge is continued, certainly not only on the OEM ability to produce aircraft at levels that they would like to produce, at the very least pre-COVID levels, but it's also supply chain issues. And third is maintenance issues, right? MRO shop capacity, airline modification capacity, the ability of the OEMs to give engineering for mod changes to transition aircraft. We're seeing pressure in all those areas. And we certainly saw, remember, this started probably 20 months before COVID with the MAX. And at the end of the day, it was probably a bit of a blessing going into COVID. You had, depending on how your production rate assumptions were, there was maybe 450 aircraft plus or minus a few that were not in the system that were probably supposed to be in the system because of the MAX issue. I think that helped asset values during COVID. It certainly helped supply issues. But as we came out of COVID, and there's a fair amount of retirements, certainly ahead of schedule retirements during COVID, again, as the airlines were just trying to survive. Now you've got this kind of massive pressure for growth and replacement and growth lift, and you just don't see the OEMs producing at the same level they did. And that's certainly driving some pressure on asset values, upward pressure, I should say. And it's also driving some upward pressure on midlife because aircraft are extending longer than they thought. Replacement aircraft aren't available. And then you kind of compound that issue with, as I said, some of the OEM MRO issues, your ability to get engines through the shop. Typically, it was pre-COVID 45 days, more or less, to get an engine through. Prior to any of the GTF issues, where we're getting quotes from 210 to 270 days to shop an engine. So it was just this long chain of trying to get back to pre-COVID levels. And then on the GTF issue recently, depending on where that comes out, I think the current assumptions are it's going to be a 2 to 3 year impact on GTF powered NEOs, at least, if not some of the other aircraft. And then you're going to have maybe some 40 to 50% downtime of those aircraft, depending on what Pratt's able to do. Hopefully, they're able to do better in that. And that's certainly going to drive pressure on asset values and upward pressure on asset values. So back to your question, what does it mean for a company like Highridge that's looking to grow? It's on the one side, it's positive for asset values because we think, a combination of inflation, higher interest rates, and supply chain certainly drives up asset values. And as an owner of assets, inflation's your friend. But you also have to be selective of what you do. I think it makes some of the opportunities a little tight, but it also provides some opportunities, particularly on the trading front with some of the other lessors that are looking to recycle capital. I think that gives some opportunities to pick up some assets, but we probably don't see a normalized supply market, Joe, and probably till 27, perhaps maybe a bit later. And again, hopefully Pratt is able to get a little bit more fidelity on what engine and aircraft is potentially impacted versus the guidance they've done so far. I think we're optimistic they do that, and that might mitigate the issue a little bit. But from what we see today, though, we still see the supply chain constraint for multiple reasons going forward for the next several years.
Yeah, and I think that speaks to what is a challenging trading environment, which you'd see in a diluted trading environment to a degree. Could we maybe, you mentioned the interest rate environment, and I think, if we were having this conversation a year ago, Greg, we knew interest rates were going to go up. They probably started that journey. The pace and scale of those rates kind of caught people out, the speed at which it happened. Your perspectives on how interest rates have settled now, are you of the view we're in a higher for longer period? And then can you talk to us a little bit about the impact that's having in lease rate factors?
Sure. Interest rates. I think we got to put it in a little bit of perspective. I'm old enough to remember when mortgage rates were in the mid-teens. So an interest rate at a 10-year money rate at 5% is not crazy. And I'd say 10, 12, 15-year treasuries at 5 to 8 is probably not crazy. It's probably more in the normalized place. But we're just coming off 10 to 12 years of effectively free money. And that drove a lot of behavior. It drove a lot of debt behavior. It drove a lot of asset acquisition behavior. And I think we're starting to get a little bit more normalized behavior. I think, Joe, the bigger issue I see is just the volatility. I mean, the markets don't like volatility. So to the extent we could get a little bit more fidelity on how we think rates are going to be steadier for longer, I think that'll be more of a stabilizing force. And second, you just got to get that yield curve a little flat, a little bit more inclined. A flat to decline yield curve just makes it harder to do long-term investments. So I kind of, not predicting interest rates. It's a sure way to be wrong, but I do think it's going to be normalized a little bit more. I think we're seeing, the likelihood of further hikes. At least it seems most people think that's less likely than more likely, which is a good thing. But in our space, the interest rates really are a function of higher inflation. Inflation first, you see interest rates respond to that and go up second, and then lease rates and residuals follow. And I think we're in the second pace now, and then we're starting to impact the lease rates and residuals as we go forward.
And on lease rates, in addition to that interest rate factor pushing it up, presumably there's also that demand pressure is driving up lease rates at the same time.
It is. You're seeing, I think, interestingly enough, you're starting to see that lease rate really tick up in the midlife aircraft, or maybe the younger midlife aircraft that are coming off their first lease that are extending. They were likely to extend anyways, but the rates that they're extending are now higher than what they thought. We're seeing in some places lease extensions, and these were perhaps short normal initial leases, but the lease extensions are very close to the original leases. So you're seeing some upward pressure on extensions, and that's a function of supply, as you said. And then on initial leases, it's just a financing cost pass through. So to the extent the lessors, the banks, whomever is providing the financing, you borrow at a higher rate, you got to pass that on. Otherwise, the investment thesis doesn't close. So you're going to see lease rates tick up, mostly as a function of you got to pass on your financing costs. And two, it's a supply demand issue. There's as you mentioned, there is tight supply now, and that's going to drive up, we believe, lease rates.
Maybe looking at the aviation debt market, parking, the alternative lender piece, which you're very familiar with from your former life and your current life, and we'll come back to it. Can you talk to us about your perspectives maybe on the traditional aviation banking market and also on the capital markets for aviation?
Sure. On the traditional side, what we're seeing, Joe, is the commercial banks continue to more or less back out of the space. And I don't think that's a risk-off approach from just the overall market of the space. I do think it's a function of the regulatory capital that they have to apply to aviation exposure, and that effectively just makes the hold returns not work for them. So the commercial banks continuing to back away. The capital markets, they say they're open to the space, but it's just hard right now to, I'd say, a clean, bankable capital markets transaction through, be it an ABS or otherwise. We're starting to see a couple of them nibble and come through. I expect the capital markets to come back. They're just not back yet. And the issuance from the cap market side has been, frankly, anemic over the past 2.5 years. It just really hasn't been much. So as the business picks up a little bit, I do think cap markets space will come back. The commercial banks will stay where they're at. You mentioned alt lending space. I think it's an interesting space. The alt lenders is really, we really kind of see two alt lenders or two types of alt lenders. There's the alt lenders that are primarily looking to put IG capital to work, investment grade capital to work, and that requires a certain obligor, lessor profile and structure. And then there's the alt lenders that are trying to do the more traditional financing, where it's senior secured over a wider range of products, but maybe the whole thing can't be IG rated. And so typically what they're looking to do is amass a portfolio of loans and then structure it out into a combination of IG and non-IG buckets, either through the CLO market or otherwise. But that's really a function of kind of renting a balance sheet on the warehouse facility, if you will. I'll call it a warehouse. Perhaps it is, perhaps it isn't. But the difference between loans and leases is loans pay off relatively quickly. So time is not your friend when you're amassing a portfolio of loans. You got to do it pretty quickly. And if your end game is to do a CLO and carve it out to pieces, you really need to build that up quickly. Then you got to get to market and do the CLO and then back things up or however else you want to structure it. So we're seeing kind of alt lenders in those two spaces kind of do those two different tactics. And certainly at LR, we're looking at both of them.
Maybe moving on to the investor side, Greg, can you talk to us about, we have a sector that has shown incredible resilience over enormous challenges, but you have to fight for investors' attention versus other asset classes. Your views on the continued attractiveness of aviation finance as an asset class, and just the type of investors we're seeing come to the space.
It's an interesting question, Joe, because there's always been this discussion of a lot of capital came into the aviation space. Initially, they looked at it and said, well, wow, it trades 150, 200 wider of infrastructure and it's secured by assets and it's global. This is great. Some of that capital wasn't long-term capital. Some people call it tourist capital. Some people call it spec capital. And some of that through COVID was, I'd say, found out that, you're not buying bonds here. The asset manager that you use to manage these investments matters because the unexpected happens. And how you manage these assets, how you cultivate the assets, how you move them to another operator to maximize cash flows, all parties aren't equal. So now what we're seeing in the space is more of a selective nose for who am I investing with and who is the asset manager here. And we're seeing more tenured capital come in. So think about more pension funds, more for sort of mutual funds that want a longer term investment thesis, not necessarily 1, 3, 5 years, but are now looking to, 7, 8, 10 years of it. That's more appropriate for the space that we're in. I mean, these are long. So I think we're seeing more longer term capital come in. I'd say more capital has been more traditionally towards infrastructure, looking perhaps for a little bit more yield. But more, I'd say, reasonable in their expectations. And the one thing I'd say that aviation finance is quite attractive for some of these folks is the long-term beta of our returns is relatively stable to some other spaces. I mean, we used to compete with commercial real estate or shipping, and you could just see the beta of those spaces just exploded in the past 2.5 years. And even through COVID, the relative beta of returns in aviation finance is pretty stable over 8 to 12 years. And I think that from a risk return perspective is quite attractive to some of these firms.
Maybe looking at the macro leasing environment, Greg, we've seen the popularity of leasing clearly increase during the course of the pandemic. Lessors via their own order books or sale and leaseback, probably funding near 60% of new deliveries, and we've breached that 50% threshold. Do you see that popularity trend line continuing, or as airlines start to generate increased liquidity, that they might step back slightly from the leasing model?
Well, the trend on leasing, as you said, Joe, it's not just an overnight trend. This has been going on for 15 years. The percent of aircraft financed by leasing has grown. And it's really a function of who's the most efficient owner and what's the most efficient balance sheet to own these assets. And this is capital intensive assets. It's a lot of capital put to work over a long period of time. And who's got the leverage that can effectively make a good return on this? And airlines can do it, but typically they just have poor leverage, and they should, right? They're not a finance company. So if you have, if you're more of, I'd say, a mature airline, you generate a lot of cash, you have tax capacity, you have your own maintenance fleet capacity, it can make a lot of sense for you to own aircraft. And even those that do frequently don't own all of them. But I think a more efficient financing source is, right capital size lessors that can provide flexibility to the airlines to sort of exit and enter into aircraft as they like. Diffuses some of their duration gap on their balance sheet. It also helps them on a fleet perspective. So I would expect the leasing market continuing to grow above 60%. Where it finally ends up, don't know, but I think that's certainly going to go higher than that.
And can I get your perspective on scale, right? So you were, one of the largest, not the largest aircraft lessor previously, and would understand the benefits of being an IG rated lessor and access to debt or investor capital. How do you think about scale now as an asset manager and its importance?
Well, scale always matters until it doesn't. And what I mean by that is you can't really have a lot of scale sub-billion dollars long term. But at the same time, the benefit in scale between 15 and 20 billion, or 20 and 25, or 25 and 30, or as you go on and on, I don't say it's the margin of diminished returns, but it becomes less critical. And there's other challenges associated with that. And as you mentioned, Joe, I mean, we had a balance sheet of $48 billion before, and that provided a lot of economies of scale. It also provides a lot of challenges when you're running a bank that big. So I think scale does matter, but I don't think you need to be 15 billion plus to have critical mass on scale. I really think it's a more priority on how you're managing the liability side of your balance sheet, right? And are you a public model, or unsecured model? Are you owned by a parent that owns a FinCo, or are you a fund model? And what's the most efficient way of managing that liability risk and making sure that liability is match funded to your long-term asset exposure? I think you get that right, and you combine that with, I'd say, that multi-billion-dollar scale, and I think you're going to be in good shape.
Just shifting gears a little bit, Greg, just to touch on the area of ESG with a particular focus on the E. As an aviation asset manager, just how high does this issue come on the agenda of either your debt providers or your investors?
Well, we hear it from both, Joe. Certainly, there's a lot of banks that have limits or requirements on how much they invest in either particular class or others, be it ESG. You hear it from investors, and they want to know what the profile is. I think the challenge in our space is really technologically, how do you transform commercial aviation into more of the E component of what the ESG says? And there's a couple ways you can do it. I think the most near term impact is sustainable aviation fuel, and there's been a lot of work done on that. I think some of the challenge with SAF is just quantum. How much can you produce versus what the world needs, and cost of doing that, and getting that to a more, I'd say, balanced model. There's electric, and electric certainly solves a lot of that E issue, as you mentioned, but there's certain physical challenge with electric, right? You can't, battery, nasty habit of not, getting any lighter when the charge goes away. So you're carrying around the same weight of an aircraft when it's fully charged versus unfully charged. That provides range and implications to that. I think where you're probably going to go long term is probably hydrogen. And I think that's, as many people said, I think that's probably 5, 10, 20 years away from really getting a good technology on that. We do hear from investors. I think it's important to know that these are very high technology, very advanced engine and power plants that are much more efficient than the previous ones. It's one of the most efficient avenues of travel there is. And the economic impact that it drives to both global GDP and economies worldwide is important. So I think we're going to get there, Joe. I think it's just probably going to take a little bit more thought, and certainly going to be probably more in the next decade.
And Greg, in closing, as your effective startup business, as you look out into 2024, what are your optimism levels like?
Look, I'm an optimist by nature. I think you have to be in this business. And I think, we mentioned at the earlier part of the discussion here about some of the global conflicts, some of the interest rate issues, supply chain issues, airline financial components. But overall, I think the great thing about aviation is it just acts like a pseudo utility. You need it for GDP growth. And I like the fundamentals we're seeing in airlines, but also with some of the macroeconomic trends. I think overall, we're going to have a good 24, a steady, a couple of shocks in there. But I think the airlines generally are well positioned. Most of them have either restructured if they needed to, or have had enough performance now to start getting themselves to a better place. I think you had a big move out of assets during COVID that I think long term are going to be helpful. And I think not only for airline investors, but lessor and aviation investors, I think you're going to see a good return on that investment and some good growth over the next couple of years. And certainly 24 is the start of that.
Right. Well, Greg, on that optimistic note, I'd like to thank you on behalf of KPMG and Airline Economics for your insights today, and wish you and High Ridge Aviation a very successful 2024.
Thanks so much, Joe. Appreciate it.